How's everybody doing today? Everybody doing good? I know the markets aren't doing good, but that's why I'm putting out very pertinent information to really help you navigate these markets. I'm going to really start putting out more series on YouTube, by the way. And if anybody hasn't, go subscribe to that channel and click the bell so you can get those as I publish them. But I think the most important thing in challenging times is to really, sharpen your tools, because I hope, at least if you're, long only, right? If you're looking to buy something, I hope you're trading less because the market isn't doing very well. I mean, if you're a short, that's totally fine. But if you're looking to buy long and make money on the long side, I hope you're trading less. So when you're trading less and less is less, your watch list isn't looking as good. You're constantly refreshing that like I am. Like the minute a stock breaks down, I'm just moving on. If it's that great, it'll pop up on another scanner in the near future. But really work on sharpening your skills. And when I say skills, I'm talking about everything from technical to mental. And your mental skills are the most important and the hardest to control, right? Because we have this is our nest egg. This is our retirement. It's very important to make sure that we are not doing anything that's hurting us in the long run. Okay. We'll talk about, Frank, we'll talk about that here in a second. I'll get to your question, but so really, we're just looking at things right now and, kind of taking it day by day. And if the way I'm looking at the market right now, and I'm just looking at the S&P 500 is I'm waiting for the snapback. Okay. I'm just sitting out. I'm waiting for the snapback because that can get really powerful and really strong. And if I get the snapback kind of like this, and then the market rolls over, I'll get out and potentially go short. Okay. But right now I am just patiently waiting, sitting on a ton of cash, not doing a lot of discretionary trading. So we're going to look at some things really today. I put out a series of training videos really today, how to trade bear markets. And today we're going to talk about the live version, right? I'm going to really do a walkthrough, kind of the checklist, right, of everything I'm looking at during a bear market and during a challenging time. You can copy this checklist. You can tweak it to your own. But I think it's important that we're not just blindly buying, because the market can go down more, right? And I'm not in the prediction business. Somebody asked, a lot of people are calling for 3,200. And let's just kind of go to a weekly chart of the S&P 500 for a second. 3,200, man, way down here. Boy, I hope not. But I mean, honestly, most of those guys, I could draw a head and shoulders breakdown right there. We just broke down. So, but I usually look at the glass half full, and that doesn't mean I'm blind to what the market is doing. But I really think targets are it's a tough game to play, because if you try to predict how far the market is going to go down or how the far the market is going up, then you tend to, have biases. And when you have biases on which way the market should go or how far down it should go, when the market turns, which we could be literally one day away from the market turning, as crazy as that sounds, as crazy and as doom and gloom as it is right now, we could be one day away from the market turning and going the upside. But if you have, in the back of your head, the market's going to 3,200 or whatever it is, right? It's going to be hard for you to pivot. I think it's best to not worry about predictions, because that's a sucker's game. Those guys on TV, they don't know I'm not going to say they don't know what they're talking about, but show me your portfolio, show me your trades. If you're really going to make bold predictions like that, show me how you're betting on a 3,200, right? If you're not willing to do that, or if you're really not betting, you're just, just entertaining the world, take a hike. Is the way I see it. A lot of these guys are just entertainers. So maybe there's some technical analysis to it. Maybe there's not. I'm not saying it can't happen, but at least the guys on CNBC, I have it on in the morning, but it is background noise. It's more for economic data than actual, looking for tips and tricks and ideas like that. So safer bets is should I know what SOH is and be in cash? Yeah, buying blindly anything is not a good idea. So my goal is to give you as many rules as possible. And sometimes I might give you, sit on hands. Yeah, I mean, that's what I'm doing right now is I'm sitting on my hands. Absolutely. But you know what? Here's the interesting thing about sitting on your hands. Right? If I have a trading system that is up 2% on the year, which I do, and the NASDAQ is down 26%, which it is, I just beat the NASDAQ by 28%. I could care less where I'm getting my outperformance on the upside or the downside. Could care less. I have a scorecard, and that's on December 31st. How did I do that year relative to the overall market? All right. So where it comes from, what cycle, what drop, what incline, it doesn't matter to me. Right. I think, and that's part of being flexible. It shouldn't matter. I would say right now, anything above break even is wildly successful based on this chart right here. Right. Anything in the positive is wildly successful. All right. So let me go through really, what we came here to go through, and you guys can ask questions, and sometimes I might refrain, if I'm going to address that later on in the class, and sometimes I might answer it on the spot. So this is really an open forum. I always like it to be. I want you to be comfortable asking questions, and this is being recorded, by the way. All right. So, the first thing I want to talk about is, so let's look at how to trade bear markets in 3 pillars. I always like to talk in terms of 3, right? Know when to take smaller position sizes. Okay. Know when you need to kind of back up a little bit, right? Know what situations to avoid completely. Just sit in cash, right? Don't go there. And know when to get back in. And I think kind of the knowing when to get back in is incredibly important because we get so negative in our minds, right? Our buy and hold IRA is doing crap or whatever the case is. We get so negative, and then we miss the boat, and the NASDAQ goes on a great run, and we were telling ourselves that it was going to roll back over any day, and it didn't. Okay, and that's just a great example of what happened in 2020. Everybody thought it was going to roll back over, and it didn't. So we're going to look at that case study. So when to take smaller trades, right? When to take no trades, and when to get back in after a really, really crappy environment. We're going to cover all of that today. I'm going to break it down in pieces, and then we'll go over. Is it possible to move your video to the left side of the screen? What do you mean by that? Oh, are you guys saying, okay, hold on. Can you see the S&P 500 chart? Can you see this? I need somebody to say, can you see the S&P 500? Okay, so we're good. Not the part with your face on it. Like right here? Is this what you want to see? Is that good? All right. All right. Sorry about that. I have dual screens, and sometimes they got a lot going on. Okay, so let's start with the S&P 500. Start with pillar 1. Really, when to know. Robert, you have to move it yourself. Okay, so really, when to know. What situations to take less position size. So the way I view it, and we have a system number 1, the weekly reversal, and I will refer to that, and we'll refer to other systems, but let's just keep it incredibly simple. Really. What I'm looking for is, when you have these smaller pullbacks, right, that's really not a big deal. We have to expect these, especially these kind of small pullbacks and these kind of small pullbacks. Like that is not in breakdown mode. But when we have, okay, But when we have, a major breakdown, like where it really starts to move below the long-term moving average, and I say the 200-day simple moving average, that's really my line in the sand. And that's when I'm looking to cut. Okay. That's when I'm looking to take half position sizes. All right. And because it's just like anything. There was a great book. I'm trying to find it in my library, but there was a great book about how the first guy that really beat the game of blackjack in Vegas is back in the 60s. And this guy basically had, he was counting cards, but he had a very simple system. When he knew his odds were less than 50%, he would bet very, very small. When he knew the odds were more than 50%, like when he knew whatever that deck was holding, he would bet larger. And he completely got kicked out of Vegas over it, but he did it legally just by counting cards. And I'm not saying we're counting cards doing anything legal, but you have to know when to bet less, when the odds are in your favor, and when to bet more. And you can have your own rules on how to do this. But I think just the easiest way to really do this and understand this is just say, hey, let's just use a 200-day moving average. And when the market is below this 200-day moving average right here, I'm now taking a half of position size. That means if I have a $100,000 portfolio, I'm putting, $10,000 into each trade. I'm now going to put $5,000 into each trade, because even though there are plenty of times, and there will be plenty of times where you get whipsawed, okay? You get whipsawed, it comes right down, it comes back out, and you're like, oh crap, I should have taken a whole position size. It's not about the times you get whipsawed out, right? Or it's not about the times you should have bet more. It's about the times that market, that 2008 type of market, just doesn't come back, okay? And your portfolio just doesn't come back. We need to think in terms of risk reward and not in terms of shoulda, woulda, coulda, right? Because there will be plenty of times where you set a set of rules and you break it and you say, ha, I told you so. I told you I knew I told you I knew it was going to top. I told you I knew it was going to come back, right? That is making money off bad decisions is the worst thing that can happen to you. It's almost like gambling when you make money your first time you go to Vegas and you just kill it and you think you're going to do it every time, right? You're reinforcing bad behavior, right? Now, I want to flip that upside down. And I've talked about a great book by Annie Duke, a poker player, doing a lot of Vegas references, but the book is called Thinking in Terms of Bets. And I always try to get one thing out of every book. And this is a phenomenal book. And just kind of one major thing I got from this book is just because it's a bad outcome doesn't mean it's a bad decision, right? You can have so what that means is you can have a 60% chance of winning and lose. But that doesn't mean that you made the bad decision because you had the odds in your favor. So it goes back and it goes both ways. So if you lose money, but it was the right decision or the system told you to buy, that's okay, as long as you followed a reasonable set of rules. When you make money by following no rules other than your gut, man, that's going to be a tough place to be, and it's going to absolutely reinforce bad behavior and hurt you in the long run. So just kind of a simple rule, right? You take one trade right here with the half position, right? Now you get up here with the whole position. This one probably made money. This one probably lost money because it went straight down. That's okay. Now you're taking half positions, right? And so on and so on. So again, you can have markets that kind of whipsaw you around, but let's go to 2008, right? This was the beginning of 2007. We all remember this. I entered asset management in early 2007. What a great time to do this. I'm kidding, but the market just absolutely rolled over, and there was a lot of whipsaws around the 200-day moving average, and it's enough to frustrate you when you set a set of rules in place. It's enough to frustrate you, but then it really started to roll. Okay, then it just absolutely, from peak to trough was down 55%, maybe. From, where it really broke down to the absolute bottom was like 48%, 47%. if you're taking whole position sizes all the way down, you're not probably doing very well. Okay. If you're taking half position sizes, that's a much, much better place to be in. If you lose 5 in a row and you're only risking 0.5%, and you're down a whopping 2.5%. If that upsets you, trading is probably not for you, because it's going to happen. And by the way, whipsaws are going to happen. The great trend follower, Ed Sakota, he's got a phrase, I absolutely love it. He says, if you don't like whipsaws, then you probably shouldn't be trading. Don't trade, because it's the cost of doing business. What we're trying to do is put rules in place, not that will just last, 10 months, 10 days, whatever the case is. I'm trying to put rules in place that will help me over 10, 20 years. Okay. Because we're going to have these outlier events, and I'm trying to protect my portfolio from that outlying event. And 2008 was an outlying event. 2020 was an outlying event. We tend to have them quite often. Okay. So ever notice how these 100-year storms happen every couple of years? They happen, these outlying events, fat tail events happen all the time. That's what we're trying to avoid. That's what I'm helping you trying to avoid. So when the market is under the 200-day moving average, you take a half a position. You can create your own rules, whatever the case is. You can also have a rule if the 50-day moving average is downsloping, take a half position, right? If you don't want to go all the way under here, that's fine. It's completely up to you. The most important thing is you can use these as a guideline, but use it all the time. Write it down, make it real, and don't quickly tweak it just because you get a few whipsaws, right? We're trying to set ourselves up for long term. So I believe I've showed this on a previous lesson. I might have even shown it last week, but I have to bring this back because the position sizing calculator is probably the greatest thing since sliced bread. It is the cat's meow. So for example, if a hypothetical $100,000 portfolio, and I normally risk 1% of my account, right now I'm risking 0.5% per trade. Okay. And if my entry price is 57, my stop loss is 54. I'm just making this up. I want to risk 0.5% or $500 of a $100,000 account. Then I click compute. It tells me exactly how many shares I can buy at this entry, at this stop loss, and that's my position size. Okay. And it's a 5.26% stop loss. So it's just so easy. It's too easy. You should have this chart your trade / position - size - calculator. You should have it bookmarked. It is phenomenal. And you're supposed to do it on every trade. Okay. So very, very simple rules, right? A couple that you can use are if it's under the 200-day moving average, half position size, use the calculator. Or the 50-day moving average is sloping down, half position size. Okay. Good on that. All right. So now we're going to move over. So that's pillar number 1. Know when to trade less, right? We're the poker players here. We're trying to beat the game of blackjack, right? Protect your chip. Protect your chip. So pillar number 2 is know what situations to completely avoid. Avoid, as they say, like the plague. So let's kind of go back to the current market environment. I think I've looked at, major indices, going back a long, long ways, right? So I believe one of the worst situations really to avoid it is what I call the waterfall. And I don't think I coined that. It's just what I call it. And I said in the video, and I joke, waterfalls are supposed to be beautiful. They are not beautiful in the stock market. Okay. But when I say a waterfall, how do you know what a waterfall? A waterfall is a straight down drop or less than a 45-degree angle drop. See, I drew this 45-degree angle. I would say this right here is a 45-degree angle. All right. But when it really, really goes down a lot less, right, or the drop is steeper, looks like a waterfall, I can kind of clear this up a little bit, then just set that one out. A lot of times, based on my research, a lot of times when you get this waterfall, that's the first leg. Okay. And if you get a waterfall on the first leg, you do not want to get sucked into that bounce. because that bounce can be violent and it can be quick and it can just drag you back down. Let's look at another waterfall. 2020. That is Niagara Falls. All right. Whatever the biggest waterfall in the world is, I don't know if it's Niagara, but that is the benchmark of waterfalls. Okay. And what's interesting is, so this is not a 45-degree angle, right? And we know, the markets don't go down just in 45-degree angles. They might do this, they might do that. You can just give it the old eye test, use your judgment, but this is nasty. Okay. So for example, look at here, you got the first waterfall and then the market reverse. I played this reversal. It was the craziest thing I'd ever played. I made money, but I was in and out within a day and a half. I mean, it was just, such violent moves. Let's kind of track these. All right. You have you got the reversal. That's probably 3% off the low, 4% bounce right there, 4.6, and then another 4% day. We don't want to get sucked in. It is not good to get sucked in on these just straight waterfalls, because it can blow up so quickly, especially if you don't have a plan. I had a plan to get in and out, but I made a little, but I almost lost because it happened so quickly. So quickly. You hit your targets, you stop loss. You need to automate the whole process. Okay. Do not flinch. Do not say, hey, but wait, what if it comes right back? Because 9 times out of 10, it is not coming back. There was a time in 2015. This was really the only true, in my opinion, waterfall that just came straight back without really giving us a second leg. And that happened in 2014, right? It looks kind of 45-degree and then it just sells off, right? And it's what we call a V-shaped recovery. Most corrections or bear markets are not V-shaped. This is one of the only ones I can find. Okay. So so when you see that, you almost have to play, you just need to step aside, not play the bounce unless you have a clear plan. And I'll talk about clear plans here in a second. Now I got a question. What about a plan to short a waterfall? A lot of times in a waterfall, they can last anywhere from 3 to 4 days to 10. They're pretty short-lived. In my opinion, there's not a lot of opportunity for shorting because it happens so quick. I mean, you'd have to be in and out, and you have to short, it's probably somewhere around day 3 when it's a confirmed waterfall. And then you'd have to pick a downside market and sell into that drop. I think that would be too tough. I think your better play, if you're going to short, is short the first bounce breakdown. That's where you short. Okay. Short the failed rally attempt. That first one, that's going to give you your best chance of success once you've identified a waterfall. So we're going to avoid these waterfalls completely, or at least we're going to avoid this first bounce completely. All right. So here's another situation to avoid. Let's talk about avoiding the waterfall. You just draw a 45-degree line, right? Another thing we know is a lot of times the waterfalls are the first leg, which means the bounce is going to fail, that first bounce, right? So what we're also trying to avoid is, getting sucked in. And this has really saved my bacon. This rule I'm about to share with you, saved my bacon. This bear market. When the 8 day is the green line, and I understand it's kind of hard to see. I can't really blow that up. Let me see if I can blow that up a little bit. No, it doesn't really give me an option to thicken the line. But this green line right here, that's the 8-day exponential moving average. The pink line is the 20-day exponential moving average. It is so easy in fast drops in choppy markets. When the market rallies 2 to 3 days, we get sucked in and we say, man, I am going to jump all over that. The market is rallying. And then it blows up. All right. So a good rule of thumb is if the 8-day moving average is under the 20-day moving average in a volatile downside environment, avoid any 2 to 3 day rallies. Just completely avoid them. Okay. So look at this, right? You have a reversal bar, which we played, right? And we did make a little bit of money on this, but only because I had a specific set of rules and we got out as it started to break down. So look at this. Anyone who's buying up here, right? They're waiting for a few days, right? Confirmation, they're buying up here, it gets slammed, right? It bounces again, gets slammed, bounces again, gets slammed, right? And the 8-day moving average, it doesn't move above the 20-day moving average to right here. All right. Then you have a legit tradable rally where you can hold it for a couple weeks. All right. But if you avoid the waterfall and then you analyze this and you say, okay, now I'm going to avoid every 2 to 3 day bounce because that's just going to whipsaw me and death by 1,000 cuts. These 2 to 3 day rallies are literally death by 1,000 cuts. Right? I'm just going to sit this one out until the 8 moves back above the 20. You would have sat out all of this. You would have gotten out somewhere around here as it's breaking down, and you wouldn't have got back in until right here. Now, usually, and that's avoiding every 2 to 3 day failed rally. Now, there is no perfect answer here, right? We're trying to do what's reasonable. And that's what I always ask myself. What is reasonable? When you have a fast drop, is it reasonable to expect a V-shaped? Based on my experience, absolutely not. Does that mean it can't happen? Yeah, it happened in 2014, but those are far and few in between. There's been a lot of waterfalls since then. All right. So when we get a volatile environment, we're trading half and we're trading less. So you can avoid all this mumbo jumbo and just get in, pay a little bit more, be a little bit more conservative. Yes, you're going to get a few days off the bottom. And sometimes these rallies are strong. You might get 6, 7, 8% off the bottom. But you know what? You avoided all these losers right here. 1, 2, 3 failed rally attempts. So, what's the trade-off? And by the way, this is really hurting your mental capital. Okay. It just wears you down. It wears you down. And then what happens? You get the rally and you don't want to touch it because you just got blown up 3 times. Okay. It happens. So then you're gun shy because you think the next one is going to blow up, right? Let it have a little bit extra confirmation, right? Because I don't care about, 4 or 5% on the market. I care about the next bull run. All right. Yeah, I mean, I agree, Robert. I'd much rather have a little bit of extra confirmation, right, than avoid all this. Because this is, if I lose on this, and this, I'm going to be gun shy on this. And I think this is from Ed Secoda as well. I think it is, but he said, you don't want your rifle empty when that white elephant walks right in front of you. And all he's saying is you don't want to be gun shy when just that perfect setup happens. And you know what is the strongest trends? The strongest trends we can find in a 2 to 3 year time horizon coming out of a bear market. Right? That's our white elephant. And it doesn't always work perfectly every time, but I have no problem with bear markets because I can sit in cash, let everybody else, get all ticked off. And when I see confirmation, I'll stick my toe in the water and I know when to push the chips. Okay. But now look at this. Okay. And we'll talk about, this failure here in a second, but look at this, right? Then it starts to break it down. So maybe you have rules to get out if it starts to roll back over, because bear market rallies will eventually fail, but they are strong. The bear market rallies can be incredibly strong. And there were some major strong bear market rallies in 2000 to 2003, that 3-year bear market, major rallies. If you avoided the downside and played the rallies, you probably would have walked out ahead while everybody else is losing 50%. Sometimes it's unrealistic to expect 20+% per year. But you know what? I'll get my 20+% per year average when everybody's down 30% and I'm up 2 or down 2 or down 5. Doesn't matter, whatever the case is. I'm fine with that because I know when we get that bear market rally or when we get that bottom, I'm going to be at 40, 50, 60%. Okay? Potentially. Throw that disclosure. So when this started to break down, and I know it's hard to see because you got all the moving averages right here, but it happened right here. Let me kind of clear this out. It happened right here. That 8-day moved back under the 200-day moving average, moved back under the 20. And then when I saw this 200-day moving average rejection failed down, I haven't taken a non-system trade since. Okay. So I am taking my FANG momentum system, my system number 3 trades, because that's a portfolio style system. You're buying all the time, and then I'm taking my system number 1 trades occasionally. And we took one last week. We made money. Yes, we got stopped out, but it was a 4% gain. You know what the market did? That was last week. The market went up and went straight down, didn't do anything at all. I'll take a 4% gain, and then we pass this week, and I'll let the market roll back over. Okay. Is that a little better? Okay. So situations to avoid. All right. Waterfall. And then if the 8 is under the 20, I'm avoiding every 2 to 3% rally. I understand there's a need that we feel like we have to be doing something, right? I need to be trading. I need to be doing something. I hear this all the time. It's funny because, I'll wake up on Mondays and, Monday is like my game time, right? I'm sending out alerts for everything. I'll wake up on Monday and I'll see the market is down like 3-4%. And I'm like, you know what? Let's just sit this one out like I did this week. Woke up and I was like, you know what? I'm sitting this one out. And it was good. And I'll still get emails from customers. They're like, hey, why didn't we buy? I'm like, man, at the end of the day, I want to guide and advise you, but I prefer profits over picks. And if I don't think I have a reasonable chance of getting you and me a profit, right? I'd rather make a few people upset because they didn't get enough picks, in a very bad market, but building the customer base for the long term, because I know that if I can help you navigate this market, right, you'll want to work with me. And this is how I trade anyway. So it's easy. Okay. Now we talked about when to trade less, pillar 1. We talked about what situations to avoid. Now let's talk about when to get in. Okay. Now let's talk about when to get in. So I'm going to give you 2 entries. Okay. Now I have other entries in my, I'm going to now kind of cut this back a little bit since we're looking at weekly trade. I think I'll blow this back up. It's a little blurry when you blow it up, but maybe you can just see it better. So I'm going to give you 2 entries. One is the weekly reversal pattern. Okay. With the weekly, and I'm going long term on the chart because you can clearly see at, some steep drop-offs. Right? You have a weekly reversal pattern at the bottom of March 2020. And this isn't going to be a system weekly reversal pattern rules webinar, right? But I'll quickly go over the rules just so you understand, right? So the weekly reversal pattern is very, very simple, right? We're looking for rule number 1. We're looking for a reversal bar. Rule number 1, undercut the previous 3 weeks. That means the low down here is the lowest point in the previous 3 weeks. 1, 2, 3, check. Rule number 2, closes above the previous week's close, check. Rule number 3, above average volume, check. Okay, I'm buying something at the open on Monday right here when I see this. All right, so let's kind of go to the daily chart. Let's go back to 2020. All right, so this is a daily chart, but there is a reversal pattern right here. Okay. Let's go to the weekly. See the reverse pattern right there? That's going to give me my lowest possible entry. All right, I'm getting in on Monday, and then I'm going to see what happens, okay? If that doesn't happen, let's go to the daily chart. Look, remember I said you avoid the waterfall and you avoid the 8 under the 20? All right, look at the green line. It doesn't move back above the 20 until it avoids all this crap. All this right in here. It's not about playing every dip. It's about entering when it is safe. Yes, I have a trial. I'll drop that link at the end of the presentation. Okay. So it's about when it's safe. Okay. So you get in right here. And honestly, and like I said, it's crazy in volatile markets because you have big days. You know, who wants to buy after the market rallied? Let's see, you know, it's 2,200, you know, 10, 15%. It probably rallied 10, 15% off the low. But who cares? Because this happened, right? Let me kind of reset this. Let me actually go to the weekly chart. Reset to the day. This happened. All right, the greatest rally we have seen since 1999 in the middle of a COVID-filled recession. And I'm going to bring up that case study until the day I die. Okay? Because it's the greatest case study I can really teach you. And because as far as like, this is why we have rules, because our opinions, they're opinions, right? They're not facts, right? We don't know what's going to happen in the market. There's too many variables on a day-to-day basis. Okay. The NASDAQ, let's go to the QQQ, made its greatest rally. And so right here, you got the reversal. It made its greatest rally. It's made in 20 years since it peaked in, I think, the end of August, since the tech bubble, in the middle of a COVID-filled recession. Like schools were shut down, you know, second wave, third, I don't know what wave we were on in the late summer. I think we were still on our first wave. Nothing looked good. Tech stocks rally. Okay. That's why we follow rules. So let me kind of go back. Let me just go back to the S&P 500. Let me go back to the daily chart and kind of go back to where we're at now. So again, right, you enter. So when I say avoid when the 8 is under the 20, enter when the 8 moves back above the 20. Now, here is the trick. Here is the, you know, when the market, what happens if the market's going to roll back over? Because if it's a true bear market, it's going to roll back over, but there are some very, very tradable rallies that we want to catch. Okay. So for example, right. So the 20-day EMA is what I call the rally line, because in strong markets, whether it's stocks or the market indices, like it's going to find support in the strong rally. So, but what you can do right here is every time the market moves above a major moving average, that's your new trailing stop, right? Like it moved above the 50, the orange line right here. Now I'm going to put a stop loss under that. Right. Then it moves above the 200. Now I'm going to put a stop loss over that. Right. So I can make sure that when the inevitable rolls back over, you're out. Right. I'm out. When this started to happen, and I'm definitely out right here. A lot of times I like to use the 20 and the 50. Right. You sell half when it breaks the 20. You sell the other half when it breaks the 50. Okay. And the reason that is because I'm a 50-day moving average kind of guy. And the shorter that you make that moving average, you're just going to have to understand the more whipsaws you're going to have. So because a lot of times, like when you have a strong rally like this, all right, let's just look at this for a second. We've got a strong rally, finds support at the 20, but finally breaks, finds support at the 50. Then moves back above the 20, finds support at the 20, then needs a deeper pullback, finds support around the 50, right? That closed below it for a day, right? Same thing right here. Support the 20, support the 50. This is a great example because sometimes we're going to need a deeper pullback than 3-4%. So kind of 50-day moving average, a lot of times that's kind of my line in the sand to say, okay, now we're going into correction. Doesn't mean we're going into a bear market. it means we're going into correction. So I got a question, and someone else asked me this. Can we use the 3 and the 8 EMA? You're going to have a lot of whipsaws. So the short, I've never used the 3, so I cannot advise on that. And even if you use the 8, I mean, like, I don't know. I mean, that's probably more of a 60-day, 60-minute chart type of thing, right? If you know, if the 3 over, I don't know. Like, that's just too short for me because these moves are violent. I think if you're using the 3, I can only imagine you're getting whipsawed out because look at how this waterfall perfectly snugs the 8. All right, then it breaks through the 8, breaks through the 20, and then it fails. Right, but it's rejecting at the 20 right here. It's rejecting at the 20 right here. You're going to have to be incredibly nimble if you do that. I cannot advise on that. Someone asked me to go back through the rules again, right, of the weekly reversal pattern. Here's another one right here. Here's another one right here. Okay, this one we actually broke even on because let's go to the daily chart. Remember, you can play the reversal pattern, but once it starts to break back down, you get out. So we got in right here. We got out right here. Okay, made a little. I'm fine with that. Now on the second reversal, we made more, right? Because it, you know, even it did not undercut this low. So the pattern's still valid. It went up and then it started to break down. We're getting out right here. So I'll clear that up, right? So the reversal pattern you can see is right there. Right there. I don't know if that's one. There's one. There's one. I mean, you can, I mean, this stuff works. Is this one? I can't really tell. I'm going straight down. Yes, that's that right there. Okay. Great entries, right? So the rules are rule number 1. Let me kind of blow this up. Rule number 1, the weekly chart must, you're looking for a reversal bar. This bar must be the lowest point than the previous 3 bars, must undercut the previous 3 bars. 1, 2, 3, check. Rule number 2, must close above the previous week's close. Just has to close above the previous week's close. Doesn't have to close above the previous week's high or the previous 3 weeks high. Just close above the previous week's close. Check. Rule number 3, above average volume. Very, very easy to do. Okay. Can you use reversals on other time frames? My face is covering the prices. Well, geez, you guys said you wanted to see my face. Now you're saying my face is all over the place. Okay, so can you use reversals on other time frames? Yes, but I haven't fully put it through the ringer like I have on the I haven't fully put it through the ringer from a testing standpoint, from a back testing standpoint, the way I have in the weekly. Okay. It works, but you might have to slightly tweak the rules. Can you, somebody asked me, okay, is it true moving averages crosses work best in trending environments? Yeah. Moving averages don't work well in sideways markets, but then again, not a lot does. I mean, it just doesn't. I'll just sit that one out. I'm fine with that. I have no problem with that. I think the hardest thing to do for most people is just to do nothing. I have no problem sitting in cash, being like, you know what? Because the most important thing is to protect your mental capital. Okay. It is protect your mental capital. And I like taking mental breaks, like, because when the market's doing good, you know, you're sifting through a lot to find the best. When the market's not doing good, you're trying to, you know, keep yourself from revenge trading, making mistakes, all the above. right? And most of those mistakes come when you're frustrated. They come when you're overwhelmed. You don't know what to do. You feel like you got to do something. Take a step back. Create your game plans on for the week on Sunday when no markets are moving. That way you can think with a clear head and a cup of coffee. God bless coffee. I don't use oscillators or stochastics. Here's how I feel about that. They're all just derivatives of price and volume anyways. Why not just use price and volume? Right. And moving averages are just so simple. Okay. I don't use any other indicators. To be clear, I don't use any other indicators other than this. I wonder if I can timeline. Okay. So that's it. We have, when to take smaller position size, pillar number one, when to avoid bear markets, what situations to avoid and when to get back in. So right now, let's go back to this market. Look, man, I don't even care right now. Like I'm in cash. Like it doesn't matter. The market is ugly and I'm completely fine with it because I know that if I keep my cool, when that signal comes, man, it's got great upside potential. Let's look, let's go to, I want to look at something. Let's go to the 2003 bear market. Actually, where's 2000? Okay. So with the NASDAQ, so it's interesting because does that go back as far as I want to? It does not. Okay, so yeah, I'm going to send out the recording. Okay. So like, look at this, for example. So we're looking in the summer of 2000. Tech bubbles popped over here. We're looking at the summer of 2000 to really the bottom at the end of 2002. And this is just QQQ. Okay. So when I talk about tradable rallies, some of them aren't perfect, but some of them, can really be tradable. For example, like this one right here, you got the 8 right there that crosses above the 20. You're getting in, you're getting back out. Maybe you're getting back out, you're selling some up here, some right here. As it breaks to 20, you're selling the rest to break to 50. Move to the sidelines. Then you get another buy signal. Okay, you're getting back in, you're trading this rally, it starts to break down, you maybe make a little bit. All right, so you're making a little bit here, you're making a little bit here. I think the most important thing is I avoided this whole mess. All of these violent 1, 2, 3, 4 counter trend rallies I avoided by just, keeping the 8 under the 20 rule. Then you got a crossover right here. Okay. Gets in, right? Maybe you sell some when it breaks to 20 and you sell the rest when it breaks to 50. And you're out again. Then you're in again. Okay. You're getting in. And then I think that's the bottom. Okay. Let's look at 2000. Let's look at 2009 real quick. How are we doing on time? I have no idea what time it is. Try to keep this at an hour. Oh, okay, good. Okay. So, and you have to keep in mind, these aren't perfect, right? I don't want to hear, but Steven said, I'm giving you tools, but we all know there's no sure thing. Look right here. You got sell off, and this was at the end of 2007, right? Markets on a 200-day. All right, you're either doing half positions or no positions. Then you get a major tradable rally. Look at that rally. It went, QQQ went from, around $42 where it told you to get in. And you can find support at the 50. You're still in. And then you're getting out up here. All right, here we get another rally. So this is a really good tradable rally that I'm talking about that can happen. Then you get another rally. All right, maybe you make a little bit. You're selling a little bit up here. Then we up here. And then we got this major bottoming pattern. Okay. All right. This one, moving averages didn't work because it was just bottoming. All right. So when you kind of get the where it oscillates in and out, then you just kind of take a step back for a second. And then you can create this. All right. I have other rules in my market timing system. Okay. Any questions? Any ticker requests? Now is the time. Let's take questions about the three pillars, how to trade bear markets first. Let's do that first. Okay, I'm back on QQQ. What about SPY? All right. Any questions about anything that I've talked about so far? Okay, so I have a fair question. Is it good for all? Okay, so I have a fair question is, do I consider valuations like PEs? No, I don't. Not even a little bit. You know, every now and then I'll consider earnings. But as far as PE ratios, I am trading growth stocks here. You are not going to find low PE growth stocks. So, and the reason I don't really, I'm a technical guy first because I can think something has the crappiest business and it's going straight up. Okay. And I miss it because I'm missing the boat somewhere. Right. I don't care about what I think about the fundamentals. I care about what the analysts, what the institutions think about the fundamentals because they're moving the market. And if earnings are supposed to go down this year and the stock is breaking out, they know something I don't. Okay. So fundamentals insert biases and opinions. And that's not to say I'm going to do a fundamental like with the things I look at, but they are honestly the last data point. Right? Like I typically don't buy like pre-revenue biotechs. Biotechs are stocks that don't have any revenue. I will pass on those because they're based on hype, news driven. I don't understand it. Is this good for all stocks and indices? Absolutely. Now, let me be clear. I'm going to refer you to last week's series when I talked about does a stock respect moving averages? Because that's important. Does it have a history of making trends? Because if you have a stock like an Amazon, for example, that has looked like crap, you know, gone absolutely nowhere for, I don't know, 2 years, and then sells off. No, it's not going to, but you have to look at the history of it and say, does it have a history of making trends? Then yes, it works. I don't care if it's got a history of going up or down, as long as it has a history of making trends. I'm trying to avoid this mess because that's hard to trade. No, I don't like scalping. I like trends. Fair question. Are these rules written down? Nope. You should have taken notes, but this is recorded. And that's why I also put the series into bite-sized pieces. All right, these are extra things that I look at during challenging environments. These are just little mini courses I'm putting together for you, right? To help you sharpen your skills during a very challenging time. That way you can come out better on the other side. It only helps if you stick to it though. What is the value? Yeah, I actually think this, yes, this is a 50 period average down here. I believe it is. Do I trade leverage ETFs? Yes, I do. Yeah, I'll trade leverage ETFs. And sometimes I'll do that. You know, it really just depends, honestly. But I will trade leverage. Look at that. Amazon. Holy crap. You talk about the woolly mammoth breaking down. That sucker is breaking down. And by the way, this is very, very healthy. This is normal. This has to happen from time to time. If you follow some rules, you're going to come out okay. So what was the question? Leverage ETFs. Yes, I use leverage ETFs. Sometimes if like, you know, I notice a whole industry is moving, let's say gold stocks, And you can pick a couple, but if I don't want to buy multiple gold stocks and then you're coming into earnings season and then you got to navigate that landmine, I'll just buy the leverage ETF. Right? Because it's so much easier. The gold has to go up regardless. Why not just 3x it and not have to deal with earnings and individual, stock whipsaws? Yes. Yeah. So give me just 1 second. Do I ever trade futures directly? Yes, I do. I go in spurts, honestly. I go in spurts. So, I'll trade futures for a while, and it just kind of depends on how much time I have. All right. It really just depends. Things get busy around here sometimes, and if I don't have a couple hours a day in the morning, then I won't. If I want to, get back into it, then I will. So, okay. So I just kind of want to let everybody know, if you're not a current customer, this is, a rules-based system, the weekly reversal system right here. Everything from the core. This is different than what we talked about. This is just my system number one. This is my bread and butter. You can go to this right here. I will drop it in the chat box if you are interested. You can learn more about that. There's a quarterly plan. There's an annual plan. You can see kind of everything you're going to get right here. It comes with the course, live alerts, scan codes, one easy to follow system, one easy to follow rules. This has really done phenomenal. And this system, by the way, is up slightly, probably by about 2-3% this year. And we've won 10 out of our 15 trades. So we've won 66% of the time year to date. I'll take that all day, given the current market environment. So you have to compare it to the market. NASDAQ's down over 25%. We're up too. So you have the course, the alerts, scan codes, even option alerts as a bonus. Okay. And I have a workshop for yearly membership right here. If that's something you're interested in, I dropped the link. It's also plan.thetradersplan.com/checkout -SWL as in Larry, N as in Nancy, T. Okay. So we'll drop that. If you appreciate the work that I do, by the way, I would absolutely love for you to subscribe to the YouTube channel and drop comments. I'm really trying to grow that channel as well. Give me some feedback as well. Would be very, very appreciated. Some of us already belong to this. Yes, Robert. Some of you are already customers and some of you are not. You can email me and I can look up your plan. Okay. So if you're not a customer, that's a great plan to join. And if you have any questions, you can email me at Steven, STEVEN @thetradersplan.com. Okay. Because I had someone that was asking about, taking a trial, stuff like that. So do we have anything else? Does anything else anybody wants me to look at before I call it a day? Okay. So I think it's been a good lesson. I think this is probably one of the most important lessons that you will come across, because you need to transition your mind instead of it's fun to think about how much we can make, but the best traders I know are focused on how much they can lose on an individual trade basis, because we can't control how much a trade is going to make. I can't control that. I don't know which ones are going to be my big winners. No one does. But I know when I do have a loser, I know I can control how much I lose. All right. Live to invest another day. I hope everybody has a blessed Wednesday. I'll send out this recording. We'll catch you on the next time.